Hello everyone and welcome back to my channel. Today I would like to discuss with you one interesting point. It came to my mind after I read yesterday the news about a company called PayPal. Just to remind you, I'm following the company and I was really surprised to see that PayPal holdings cut to underweight from equal weight by Morgan Stanley. PayPal holdings price target cut to $51 per share from $74 by Morgan Stanley. I'll be honest with you, I don't really pay attention a lot to the analyst estimates, but it influenced the stock price. The stock went down roughly 3% in the beginning, but then it managed to come up a bit. But when I see such a reputable name of the financial institution like Morgan Stanley, it's one of the leading institutions which cuts the price target roughly half, I just decided to go a bit deeper. How it's possible? What does it mean Morgan Stanley? Is it the whole institution decided that, or there must be one specific person who is responsible for this number? And yes, when I went to the analyst ratings page where you can actually see all the names of the analysts, they are Wall Street analysts of different institutions. You can see their price targets, you can see when they updated it last, then their rank, etc. I found this James Fawcett, which is analyst from Morgan Stanley, got it to 51. Also, then Dolev followed him and put the same price target. I thought, okay, $51. Let me remind you, this is the trend of the PayPal stock. Now the price is 59 something, 59.4. They suggest it should cost 51. It's the all-time low, actually happened 2 years ago. By this I would think that the company is regressing, that there is no progress at all, because over the time, if the stock price decelerates, I would expect to see the company's business doing worse and worse. What do we see in fact? If we go to the company's earnings page, let's go back. So here maximum I can see backtrack till 2018. Since that, the company was going up and up. Yeah, it was the kind of peak on 21, then it's improved in 23, and then in 25th it's gonna be the maximum for the earnings from the earnings perspective. The same goes to the revenues. I don't look now a lot on the projections here because they're coming from the analysts, and now I am a bit doubtful if I should look at them. Then, so we can see that the company is earning more and more. So then I thought, who is this gentleman, James Fawcett? And then in this page you can actually track his and other analyst results. And then you can see his success rate is 63%, which is not bad, but the average return is just 4%. We go down, 48%, 6%. Then negative return. Then it's better than previous analysts, average return 8 and success rate 62. And this analyst from Bernstein suggests that the company should cost $76, and the update was 3 days ago. Such a discrepancy. And also, if you look at the angle, how wide it is from 51, which is a low target, to 105. And these are the analyst estimates. These are Wall Street people who deal with the companies, with the numbers. They are educated in this specific area, and yet the figures differ so dramatically that I don't even know should I follow these numbers or not. I'll be honest with you, after what I've seen here, I'll prefer to make my own research, even though I'm not educated financially in university, even though I don't have such experience as them, but I've been listening to the company's earnings call, I've been following the news, I've been reading the earnings report, and honestly, I would trust more the management of the company rather than thoughts and ideas of these analysts, whose success rate is more or less half, which is just as a gamble, I believe. I don't see the major achievements here to trust any one of them. However, what is interesting, if you go here to the analyst forecast here, I don't know where exactly it comes from, but if we choose annual, and we can see here the earnings per share, net income, book value, gross margin, and other important parameters for the company and revenue, you can see that the projection is only going up and to the right. For the revenue, going up. For the earnings per share, going up and up and up. Why would analysts from the Morgan Stanley suggest that the company, which is supposed to progress, earn more and more, why does it supposed to cost the very low price for the stock? I don't get an idea, and I'm really curious where the source. Okay, the source is Refinitiv. Looks like the analysts from Refinitiv make these projections for the specific company. But for me, the main and the only main source which supposed to be reliable remains the company itself. I prefer to read their earnings report, and this is something that I suggest to do yourself. At the end of the day, you are the one who are investing in the company, and you want to make your decision based on your thoughts, on your beliefs, rather than pointing someone, this guy said it's gonna cost 51, that's why I'm gonna, let's say, short the company. And then you're gonna blame this person that you listen to him instead of listening to what you think supposed to be. Also, this James Fawcett, you can look at his profile, also at the webpage TipRanks. There is a bit more information, but if you want to do like really deep dive, you have to pay for the service. It just mentions that he's number 1665 out of 10,000 of Wall Street analysts. Some of his results here, and what were his reasons why he was saying it's $51, and this is a Google Gemini source. So he mentioned 4 specific factors. First, branded checkout erosion, then the agentic commerce risk, then Venmo monetization failure, and earnings revision risk. Branded checkout. He argues that the PayPal's branded checkout is losing market share to competitors like Apple Pay and Google Pay. To be honest, there might be as many competitors as you want. The market is huge. The population is growing and growing. People are spending money and spending. So there will be enough piece of pie for everyone, in my opinion. To me, the best indicator for this would be the earnings of the company and the guidance of the company itself, and we will take a look at it a bit later. Then the agentic commerce risk. This is a forward-looking concern. I wonder how much forward does he look, because the price target that they make is usually 12 months price target, and there is still no agentic commerce in force. I don't see that anyone is buying any stuff from the ChatGPT yet. And he's saying, as AI agents begin to handle shopping and payments for users, Fawcett believes PayPal is poorly integrated compared to API first players like Stripe or Adyen. Just to remind you that the PayPal was the first to make a deal with the OpenAI and ChatGPT for the e-commerce. Honestly, it's really doubtful, this factor. I don't take it. Then Venmo monetization failure. The window to capitalize on Venmo's younger demographic is closing. Basically, here he's saying that Venmo monetization is going downwards. This is something that we can have a look in the earnings report, if they're actually going down or not. And the earnings revision risk. Finally, he anticipates that the PayPal will have to reset its medium-term targets downward. And when I read the last one, it's just the last point when I just refuse to take any of his factors. Here is the PayPal third quarter results, which were released 2 months ago. The earnings report had a triple beat on the revenue, earnings, and the guidance. The analyst, Wall Street analyst, says they have to review their guidance on downward. In fact, the company is raising their full year 2025 guidance. Now they expect 15 to 16% of non-GAAP EPS growth. And we'll have a look later on how much they projected earlier on. So here they are saying that they raising full year 2025 guidance. Now expect 15 to 16% non-GAAP EPS growth. Then let's look at the other points. Here is the combination. This is the branded experiences, win checkout and scale Omni and grow Venmo parts. You can see how it has been doing over the time. For the last 5 quarters, it's been going up and up and up. What was he saying about branded checkout and Venmo? That is losing market share and also Venmo monetization failure. I don't see it. I see the actual result here. So the company says online checkout and Omni initiatives accelerating US branded experiences. Total processed volumes growth to 10%, starting to scale globally. Pay with Venmo. Total processed volumes grew roughly 40%. Then let's have a look at this page. It's about Venmo. Deepening Venmo engagement and driving faster growth. Total processed volumes plus 14%. Have a look on the comparison here, 2023 and 2025. 10% year-over-year basis, more than 20% on the year-over-year basis. This is all together for the P2P, Venmo debit card and Pay with Venmo services. And they project more than 45% of Venmo revenue growth from Pay with Venmo and Venmo debit card. These are the exact figures and what the company is saying. Speaking about the agentic commerce risk, the company released this service as well, agentic. So they introducing agentic commerce services to help merchants sell through AI platforms, forging partnerships with the industry leaders, including Google, MasterCard, OpenAI, and Perplexity. Maybe I've read something wrong. This is the forward-looking concern. As AI agents begin to handle shopping and payments for users, Fawcett believes PayPal is poorly integrated compared to the other players. Well, interesting. That's not what I see here. Also, guys, you can have a look and familiarize yourself with the numbers here. Year-on-the-year growth for the non-GAAP EPS 12%, etc. Account and activity metrics here. Total processed volumes here and other key figures. But here is the guidance. So they are raising it. Again, let's have a look. He thinks that they need to reset their targets downward. He knows better probably. But he thinks that the company has to reset its medium-term targets downward. Probably he knows better than the company itself. What was mentioned in the report, the previous guidance in July and the latest in October, they expected that the earnings per share would be from 5.15 to 5.30, and they updated the guidance from 5.35 to 5.39. They are more exact here, so the growth 15-16% rather than 11-14. Free cash flow. Can you imagine? They've got 6 to 7 billion US dollars cash flow. This is the more than 10% of the company's capitalization. And let me remind you that they got share repurchase plan for the $6 billion. So 10% of their capitalization they are going to buy back. So I would like to conclude. I honestly don't get why still the price of the stock still is influenced so much when some institution updates their target. Obviously there are reputable names like Morgan Stanley. When probably some trading bots start to make their trades based on this news, but for me this doesn't make any sense. When I see the Wall Street analysts and their ranks and their results being more or less like in a gambling roulette, like 50-50, with their success rate of being 16% and the average return being 4%, and I see the other analysts saying no, the company should cost $100, like why would I need to listen to this guy and not that guy? Instead, I will do my own research. So I suggest to make your own research, to believe your eyes, your ears, and trust the management of the company. I believe if you've chosen some company, you have to trust their management, their CEO and other members, what they say, what they project, and this has to be taken as the primary source, not the analyst numbers. And I think in my next reviews I'm not going even to touch the analyst projections as I used to do, because for me it's nonsense. That's it for today. This is the topic I wanted to discuss today, and this is indeed subjective. You guys might disagree or agree with that, but looking at what I've seen, these numbers don't make any sense, and I don't know why the company with the earnings per share growth of 12%, why it has to be traded at price to earnings ratio roughly at 7-8. Now it's, by the way, 11, and is the lowest for the history of the company. By the way, I asked Google Gemini what was the historical price to earnings ratio for the company. You can see that throughout different years it was quite different, having really big multiples here, and then going up to date it's going down and down, and now it's at 11 more or less, and this is the extremely low price to earnings ratio as I see for this company, which is expected to grow, which is expected to buy back its shares, which started to pay dividends. The company is at the stage of turnaround with the new CEO in place. It's not new, it has been leading the company for the last 2 years already, but he has made so many changes and updates to the business that it will definitely bring its results. I mean positive results. Alright guys, thanks for watching this video. I would like to hear your comments if you agree or disagree, if this analyst topic is essential, if you even look at the numbers, what they project, and yeah, I would like to read your comments and I'll reply accordingly. Please don't forget to hit the thumbs up button if you like the video, and I'll see you in the next one. Have a good day.